Figma has been one of the most talked about tech IPOs of this year, but its IPO price has taken a hit, falling 43% as of this recording. While some investors may shy away, I see this as a potential long-term opportunity. And that's why I built a 10-year forecast for revenue and free cash flow, and my fair value comes in at $52 per share, suggesting that the stock is trading at a premium. But here's the catch. If Figma dips into the mid-50s during a typical September market dip, it could become an amazing buying opportunity. In this video, I'll explain what makes Figma stand out with its design software, then walk you through its financials, break down the bull and bear case valuation, and when I'm planning to enter the stock myself. So yeah, let's jump in. Now let's start off by looking at some historical data over the past year and see how Figma has performed. Now we can see that revenue grew close to 50%, that's really impressive growth. However, EBITDA was negative close to $900 million US. Now this was due to a one-time expense related to the termination of the proposed acquisition by Adobe, so the EBITDA margin was indeed negative in the past year. Now the share price is down 43% from its highs since the IPO, and the company is headquartered in San Francisco in the United States. So what makes Figma unique? Well, at its core, Figma is revolutionizing how designers and teams collaborate. Figma's platform enables real-time collaboration on digital designs, allowing multiple users to work in the same file. Its intuitive interface and seamless collaboration features have made it a favorite among designers. And Figma has grown rapidly, and competitors like Canva struggle to replicate the same deep collaborative workflow. And what sets Figma apart even more is how it's outcompeting Adobe. Many designers prefer Figma's cloud-based platform, while Adobe's products remain largely desktop first. Figma's modern interface makes it stickier than Adobe's slower to evolve ecosystem. And financially, Figma has been delivering impressive growth, with revenue scaling faster than most in its space, reflecting both the strength of its product and the expanding market for design software. And with that said, I think the bull case is quite strong. First of all, we have product stickiness. Once a design team adopts Figma, switching costs are high, and the collaborative features make it a platform many teams won't leave. And then we also have market growth. Digital design is growing rapidly, with digital products and app development accelerating. Now, with that said, we also have a bear case, of course. We have competition. Canva and Adobe's legacy tools could catch up. Any missteps in scaling enterprise adoption or rolling out new features could slow growth. And then lastly, we have market timing that we as investors need to consider. Tech stocks are volatile, especially in September, historically the weakest month of the year. So a short-term decline could push Figma into a more attractive buying range. And before we jump into the valuation, let's take a look at some historical performance of Figma over the past few years. Now we don't have the typical 5 years of data, but at least we have 2 years that we can take a look at. And here we can see the core financial performance. We can see revenue in blue, and we can see EBITDA in green. Now we can see that revenue has grown nicely in 2024 by 49%. However, EBITDA, as I mentioned before, was a huge decline due to some one-off expenses. Now, as those expenses are behind us, and I expect revenue to continue to grow, right, I think this company will become profitable on an EBITDA basis quite soon. Now, another really important chart has to do with the debt sustainability within Figma, right? To see if that is any risk for us as investors. Now, this is a quite interesting chart because we see debt in purple and we can see the relative size to the excess cash in the company. So yeah, that is pretty much no risk at all for Figma right now. Now, as we later on, of course, we'll take a look at free cash flow in our valuation forecasts. Let's also take a look at the free cash flow performance of Figma in the past 2 years. Now, here we can see again revenue in blue, and we can see free cash flow to equity. That's the relevant free cash flow to us as equity investors. And we see this huge spike in 2023, and then we see the decline right in 2024, partly due to those one-time expenses that affected EBITDA negatively as well. And as always, the final chart has to do with the share performance of the company. Now, this isn't that interesting because we're lacking a lot of data, but what I like to add is the number of shares outstanding in the company. Currently, we're at 487 million. I expect that to expand in the coming years. Even though the company might buy back stock, it will also issue stock-based compensation. So in my valuation, I expect this to increase by 1% per year, all the way up to 538 million in 2034. Okay, so let's move on to the exciting part, which of course is the valuation part. And as always, I'll start off by going through all my assumptions just for full transparency, so you know exactly what I'm thinking in my valuation. And this goes all the way up to 2034, so basically 10 years including 2025. And let's start off with the average yearly revenue growth that I'm forecasting. Here I'm forecasting 27%. Now that's lower than the 49% we've seen in the past year, but 27% is still ambitious, right, to keep that going on average for 10 years. Now, in terms of EBITDA margin, I'm assuming 40%. That's in line with Adobe's current EBITDA margin. That's the most comparable company that we have today on a mature basis. But in the past year, of course, the EBITDA was negative for Figma. Now, in terms of enterprise value to EBITDA multiple, I'm assuming 35 times. That's a premium multiple for a premium company. Now, let's move on to my free cash flow assumptions. The average yearly free cash flow growth, I'm assuming at 34%, and it's higher than the revenue growth, right? So assuming as the company becomes larger, that the profitability will also improve with that as well. Now, in terms of free cash flow yield, I'm assuming 3%. That's how much free cash flow we get relative to the share price. And this is also in line with Adobe's historical free cash flow yield. And finally, the discount rate I'm using is at 10.3%, which I think is quite fair for a tech company like Figma. And here you can see basically a complete overview of the revenue and the free cash flow that I'm forecasting for Figma all the way up to 2034. Now you can also see the yearly growth rates for revenue as this orange dotted line and free cash flow as this green dotted line. Now, what's important to note here is, of course, that the growth rates are much higher, right, in these first few years as the company is currently growing really fast. But basically, I'm decelerating both free cash flow growth and revenue growth all the way down to 2034 at 15% each, right? However, in the years before that, I have a higher free cash flow growth, assuming that the company can expand its profitability and become much more profitable, as we can see, for instance, with Adobe today. And as I showed you in the introduction, if we discount all of those future free cash flow to a present value of today, we get a fair share price of roughly $52, implying that the company is trading at a 33% premium and that we could get an annual return of 16%. Now, the stock is dropping quite quickly, right? It was all the way up to $120, so I think in the mid 50s isn't that unreasonable, especially if the broader market dips in September, as it usually does. And this waterfall chart basically shows us how this investment could pan out if we decide to invest in the stock today at a premium price. So we have to, of course, buy the stock today, then we get some free cash flow distributed to us each year, right, as dividends or buybacks or what have you, and then we basically have to sell the stock in 2034, and then we can see the total gains relative to our initial investment of today. Now, our valuation was, of course, based on optimistic revenue and free cash flow growth targets. Let's also do a bear case analysis and see what happens to the fair share price if our revenue and free cash flow does not grow in line with our expectations. So in this case, I'm assuming revenue growth of just 13% on average per year and free cash flow growth of 17% on average per year, which is quite high still, right? And if that's the case, then we can see that the fair share price drops to just $16 per share, suggesting that the current stock price is trading at a 343% premium and the annual return drops to -1% per year. And this really shows how much you have to believe in the company and its mission, right? Because if it does not grow in line with those expectations, then there is some risk that you as an investor could actually long-term lose money on this investment. Now, let's take a look at my personal strategy and how I'm planning to potentially add Figma to my portfolio in the next coming weeks. And here you can see basically an investment positioning landscape of different types of stocks, comparing if they have a weak business, a great business, and if they're undervalued or overvalued. Now, the best companies are up to the right. So the question is, where is Figma today? And I'd say Figma is here, right? It's a great business, but it's slightly overvalued, and hopefully if the stock price declines in the coming weeks, Figma actually moves upright to the undervalued section as well, among other great companies. Then I think it becomes a much more interesting investment, as it's a great business and it's also undervalued at the same time. Now, what makes a great stock, in my opinion, isn't only if it's a great business and that it's well priced in the market, it needs a third element, which I call momentum. So let's take a look at a technical point of view and see if Figma has any momentum right now. Now, of course, as Figma was a recent IPO, we don't really have that much to look at in terms of a technical analysis. What we do know is that the stock is declining rapidly. We see it peaked at roughly $140, and today it's basically half that, right, at $70 a share. And if we zoom in a bit, we can see that the stock price has broken below its previous support line, right? So the stock could definitely reach our price target at $52. That's our fair share price. Now, for me personally, I'd probably start off by buying a few shares in the mid 50s. If the stock continues to decline to our fair share price, or even below that, right, that's entirely possible, then I'll probably increase my position incrementally in Figma. Now, there is a risk to this as well, that the stock price never declines to those prices that we're looking at, and that the stock basically continues upward from where it is today. And here you can basically see what happens to the annual forecasted return that we have in our valuation if the stock price continues to decline or if the stock price goes up. Now we have a fair share price at roughly $52, and that should land at roughly 20% per year, which I think is really attractive from an investment point of view. Now, if the stock continues to decline down to the 40s, then you could get even higher stock returns. It all depends on where you feel comfortable entering the stock. Now, given the premium that the stock is trading at today, I've given the company a whole recommendation and 3.5 out of 5 stars. And yeah, here you can see all the detailed considerations that have gone into my final rating. Where the company doesn't really perform that well, of course, has to do with EBITDA growth and free cash flow growth, and that it's not really well priced versus its fair share price. Now, if this were to change in September, then this of course increases, right? Then the company is well priced, the rating increases to 4 stars, and then the company becomes a potential addition to the investing edge portfolio long term. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. So yeah, thank you, and I'll see you in the next one.